We're always told how we should invest our money. But what happens when the mathematically correct advice is actually the wrong advice for you? Well, today we're jumping headfirst into the DCA Trap, this huge conflict between what the numbers say and what actually works for real, live human beings. All right, let's just jump right in with a scenario. Imagine you get a surprise windfall, $20,000, cash in hand. What do? Do you invest all of it right now in one big lump sum? Or do you play it a little safer and spread it out, say $1,000 a month for the next 20 months? Now, this is the core dilemma, and trust me, the answer is way less simple than you might think.
So that second option, spreading your money out over time, well, that has a name. It's called dollar cost averaging, or DCA for short. It's a super common strategy where you just invest a fixed amount of money on a regular schedule, say once a month, no matter what the market is doing. If prices are high, your money buys fewer shares, and when prices drop, that same amount of money scoops up more shares. Simple.
And you've probably heard this advice a million times, right? But why is it so popular? Well, honestly, it's because it just feels good. It feels safer. It takes the stress of trying to perfectly time the market completely off the table. And maybe most importantly, it helps us all sleep at night by calming that little voice in our head that's terrified of putting all our money in right before a giant crash. It makes total sense, doesn't it?
Well, hold on a second. Because when the number crunchers and the academics got a hold of this common sense strategy, they came to a very different conclusion. This is what we call the academic takedown of dollar cost averaging.
I mean, listen to that. That is a direct, brutal quote from a major study on this topic. Least desirable performance. Wow. They're not exactly pulling any punches there, are they? So let's see where that came from.
This whole takedown really started with a 1993 paper by two researchers, Knight and Mandell. And they really put DCA through the ringer. They looked at it mathematically, they ran computer simulations, they looked at historical data, and every single time they found the DCA just didn't measure up to a simple lump sum investment. Okay, so why? Why would the supposedly safer strategy actually perform worse? Well, the reason is almost laughably simple. Most of the time, the market goes up. Yeah, it has bad days and bad years, but the long-term trend is pretty clearly upward.
And this all comes down to one key idea: opportunity cost. See, when you're doing DCA with a big chunk of money, a lot of that money is just sitting on the sidelines as cash, waiting its turn to be invested. And in a market that's generally climbing, every single day that cash is out of the market is a missed opportunity for gains. That money just isn't working for you. The math shows it's a losing bet roughly 2/3 of the time.
So, case closed, right? The math says DCA is a loser. You should always invest in a lump sum, but hang on. All of this assumes that investors are perfect, rational robots who only care about maximizing returns. And you have to wonder, does a clean, perfect mathematical model really capture what happens in the messy, emotional, and kind of chaotic real world of investing?
So let's get out of the lab and look at some real-world evidence. There was this fascinating study done in 2008 that looked at actual mutual funds in Taiwan between 2000 and 2006. And what they discovered, well, it paints a very, very different picture.
And here are the results. Just like the math predicted, yep, lump sum investing had a slightly higher long-term return. No surprise there. But look at the other two rows. The risk, the sheer volatility of the investment, was way lower with DCA. And here's the kicker. The risk-adjusted return, so how much return you actually got for the amount of risk you took on, was higher for DCA. When you factor in the wild ride, DCA was actually the more efficient strategy.
I mean, this quote from the study says it all. DCA has higher mean variance efficiency. Now, that's just academic speak for getting a better bang for your buck. It tells us that there's way more to this story than just chasing the highest possible number on a spreadsheet.
And this really gets us to the heart of the entire debate. It's a battle between two completely different kinds of investors. Let's call them the robot and the human.
The robot investor is the one from all those academic papers. Its only goal is to maximize returns. It feels no fear, no greed, no regret. It would never, ever panic sell. For the robot, lump sum is the clear, logical choice. But then, there's us, the human investor. Our goal isn't just about max returns, it's also about minimizing regret and honestly, just being able to stay in the game. We're wired for fear and greed, and our biggest enemy is our own tendency to sell at the absolute worst time. For us, the optimal strategy might just be something else entirely.
This is what a lot of behavioral finance experts call survival value. DCA isn't a math trick, it's a mental shortcut, a heuristic that helps us manage our own flawed brains. A researcher named Mir Statman pointed out way back in 1995 that it reduces that awful feeling of responsibility and regret you get when you time the market wrong. It's basically an emotional insurance policy against the sheer agony of going all in the day before the market tanks 30%.
So after all that, where do we land? Let's boil this whole thing down to one simple, powerful idea. It's really about changing the way we think about the goal of our investment strategy.
And here it is. This is the whole ballgame. Dollar cost averaging is not a strategy designed to beat the market's math. It's a strategy designed to help you beat yourself, to overcome your own worst instincts, like the fear that tells you to sell at the bottom and the greed that tells you to buy at the top.
I think the best way to think about it is like a diet, right? There might be some scientifically perfect diet out there that guarantees maximum weight loss. But if that diet is so miserable and restrictive that you quit after 3 days, it's completely useless. The good enough diet that you can actually stick with for a year, that's the one that's going to get you real results. DCA is the good enough plan that actually keeps you investing.
So maybe, just maybe, we've all been asking the wrong question. Maybe the goal isn't to find the one, single, mathematically optimal strategy. Maybe the real question we should be asking ourselves is this: what is the strategy that I, as an emotional, imperfect human being, can actually stick with when things get scary? Because at the end of the day, the best plan in the world is totally worthless if you can't follow it.